This talk is by Dr. Jessica Stauth. Dr. Jessica Stauth is Quantopian's Vice President of Quant Strategy. Quantopian, a crowdsourced quantitative investment firm, inspires talented people from around the world to write investment algorithms. Jess and her team are in charge of selecting the algorithms from the Quantopian community for our portfolio. Quantopian offers license agreements for algorithms that fit our investment strategy, and the licensing authors are paid based on their strategy's individual performance. Previously, she has worked as an equity quant analyst at the Starmine Corporation and as a director of quant product strategy for Thomson Reuters prior to joining Quantopian in August of 2013. Jess holds a PhD from UC Berkeley in biophysics.
Thank you very much, Jamie. Quickly read this disclaimer, memorize it, internalize it. Okay, that was probably good enough, right? So I'm going to talk today about this algorithm selection process. That's really the focus of what I've done since I started at Quantopian approaching 4 years ago, which I feel like is starting to make me seem old. Just for sort of a step back, this slide is a schematic from a deck that we show. I guess we might have started showing this when we were doing investor pitches for VC side of the business, but now we show investors as well. So to try to explain to institutional investors, right, how is Quantopian set up? One way we think about it is sort of broken into two pieces, the research process and then the investment process. So the thing that's different about Quantopian is that the research process is largely external to Quantopian, and it's done by folks like you in the audience. So the research part of our platform is made up of the community, the software platform that we put on the internet, and then the data that we plug into it. And then separately, and in the last 18 months, we've built out sort of piece at a time this investment process. So algorithm selection is what I'm going to talk about today. But if you see Jonathan Larkin's talk, which I think is right after this, he's going to talk about the portfolio construction and a bit of risk management. And then we built out a trading and execution platform, which previous to launching our investment vehicle was all handled through Interactive Brokers, which is still on our platform. But this has been, I would say, certainly the most work I've ever been part of or seen happen in an 18-month time scale to get this thing together and launch it. So that said, I'm just going to talk about algorithm selection. And there are three key steps to the way we think about selecting algorithms. The first most important step is that we mark every algorithm's birthday, right? So every time anyone on the Quantopian platform press backtest, a copy of that code is saved and associated with a backtest that they ran. It's great for you, the user, because when you go back and look at a backtest, there's a little button that's often not noticed in the upper right-hand corner that says View Code, and you can view the source code that was run for that backtest. So should you mutate and update and change your algorithm over time, it's always possible for you to go back and understand, hey, I had this thing that looked really good and then it stopped working. What was it that I changed? You can look at the source code and then you can actually go look across all backtests, select two different backtests and compare your code and see a code diff as well. So that's really the basis and the infrastructure that allows us to build an algorithm selection process, is that we have this enormous database of, I think we said 400,000 or 500,000 algorithms with all of this metadata that we can extract. So when the algorithm is born, we can run a backtest at that time on our internal infrastructure. So we can grab every algo we want to run a backtest for. And the reason we're running our own backtest and not trusting your backtest is because you had a certain set of constraints or capital base or cost model and ideas about what dates you might care about. And we want to compare every algorithm that we can on an apples to apples basis. So the first thing that we do is run a backtest where we just overwrite start date, end date, capital base, and a cost model. So we can do that on in-sample data. And when we were first getting started, that's what we did. And we knew this starting, but you really learned that the best in-sample returns and process you ever see are often very weakly predictive of what's going to happen in the future. So the painful reality is you basically just have to wait for the future to unfold and then see what has worked. That's the second part of our process. So since we sort of got over the hump of waiting 6 months in some sense in the first place, although by the time we realized we should do this, we had algorithms that were 18 months old. So the first algorithm I found, vetted, and allocated capital to was 18 months old, which if you work at a startup and you realize you're doing something effectively like a whole year later than in theory you could have, you have a lot of like introspection about that. You think you're moving so fast, and you're like, well, we wasted literally a year here. But whatever, we choose to move forward. So that was interesting. We thought we would have to wait, and we're like debating this idea of we have to wait, and we realized like, oh, we already waited. And so we can look back in time. So that's the second piece. So we look for true out-of-sample data. What that means is that we, on a monthly basis, go to evaluate strategies. We're evaluating everything that was created 6 months ago. But we're going to run a simulation up through today. So now we can know that there's a 6-month time period that the algorithm author cannot have seen. So we trust. We trust and verify that we think that's useful. Last stage I will skip over just in the interest of time, but we run a diligence process once we select an algorithm and want to sort of move from the low touch to the high touch process. So we don't just take this code and blindly deploy it against capital in the market, but we reach out to the person, understand the economic rationale, form a business relationship with that person, run a background check like they would be an employee. We also run a lot of performance and operational checks on the algorithm itself and may need to do sort of robustness improvements. The algorithm's written 6 months ago, right? So if you're familiar with the Quantopian API, it changes certainly on the scale of every 6 months. And so often there might be something where same concept can be applied, but there's a smoother API, let's say now. So there'll be some code changes we might do. And if we do have code changes that we or the author initiate, there's a revision portal where revisions can be requested and verified. So it's a sort of a meeting place for us and the author to have revision tracking of any changes that are made. The goal would be not to make any changes meaningful enough to invalidate that 6 months of out of sample. If we think we do need to do that, we'll wait for more out of sample. And that's a conversation with the author. All right, so this is a great example of, I co-wrote this talk with Delaney, who's here in the back, and my joke here usually is if you put together a presentation with a millennial, then good luck not having at least one GIF showing up in your presentation. Right, so you think you have a great algorithm, and everyone does, right? Just like everyone thinks they're an above average driver, everyone thinks they have an above average algorithm, and if you don't, I guess why are you doing it? So how do some of these look? So I'm going to go through a bunch of algorithms that I actually evaluated from our database and talk to you about sort of how they made it so far and then where things kind of come off the rails. I also have to give credit where it's due for the lovely code names, which I'm curious if you generated with a website that generates random code names or something, or you've creatively picked these yourself, but I love them. So here's the Illinois spider. Looks good, maybe too good if you're used to looking at strategies like this. And so we realized that this strategy looked awesome in sample, right? If I see this and I only had the in sample, right? So if I was evaluating this 6 months ago, I'd say, oh, okay, I expect a Sharpe of 4. That sounds great. Where do I sign up? 6 months later, I've realized a Sharpe of 0.4. Now, that's a smaller set of data, but it's still falling outside of this cone of expectation that we project forward. So what we do is use the in-sample data to develop an expectation or sort of a prior about the statistics, the returns profile of the algorithm, and then we play that forward through time. Say, if everything stayed the same, this is kind of what should happen in this envelope. And then we overlay what does happen. And it's usually pretty, it can be easy to see when the expectations are not being lived up to. So the problem for the Illinois spider is that the out-of-sample performance is not so far living up to the in-sample performance. So I think for my money, out-of-sample results not matching in-sample results, it's a huge red flag for overfitting, right? It's not impossible, again, because you're talking about 2 different timescales, and so there can be regimes when strategies don't do that well, but my rule of thumb is if you're seeing performance out of sample that has never happened in your in-sample, then that's a cause for concern, if not sort of the nail in the coffin. So how do we think about that? We like this academic result from Marcos Lopez de Prado, who I think is here and speaking later this afternoon. And so he has a nice paper, the Sharpe Ratio Efficient Frontier, where he finds a result, I've simplified a little bit, that says if you observe 6 months of out-of-sample daily returns and you see a realized Sharpe of 1 or better, you have a 75% probability of having a positive Sharpe ratio going forward. Not a Sharpe of 1 or more going forward, positive. That is sort of the way that we think about the game starting out, is we are looking for strategies that have a positive expected value. That is basically binary win in our view. We like strategies that have a Sharpe of 1 or more. Yes, fantastic. What we'd like to do is not select strategies that have a negative expected value, right? Like, I've come to appreciate more and more that finding things that are going to make money is great. Finding things that are not for sure going to lose money is also extremely important and not as easy as it might sound. So let's get to our next example. All right. So up next is the Vermont Trout. This we know now that we're looking to compare the in and out of sample. So here, the out of sample looks not that bad. So we had a Sharpe of 1.8 in sample, dropped to 1 out of sample, cut in about half. I actually typically think of expecting a haircut of about half on the Sharpe from in to out of sample, although I was talking with Gordon Ritter, who spoke earlier today, and he had an even more sort of depressing view, and he said he subtracts 2 for what he thinks the in sample to out of sample Sharpe drop-off is going to be. So this doesn't, I think, mean that the strategy is woefully overfit. So let's drill sort of one level deeper into this analysis then, and look at some of the other time series-based risk and returns plots. So if we look a little bit deeper, now we see the problem, at least for Quantopian standpoint and my standpoint with this strategy, which is you can see in the upper left and then upper right, I'm plotting a rolling portfolio beta to SPY. So what is your exposure to the market? If that number is 1, it basically means the market goes up 1%, you go up 1% on a trailing 6-month basis, and so on. So we're here looking at this past our screens because I think on average it's probably just below 0.3, which might be what we are looking at this point in time. But you can see that on a 6-month basis, it's spiking up as high as about 0.5, and the net exposure is actually closer to 1. So why is this a problem for us? So it's a problem for the way we run our investment strategy because common factor risk, dollar market, and sector exposures, they don't have the property of diversifying away during the portfolio construction process the way idiosyncratic risk would. So we have found very clear to us through the work we've done over the past year and a half, that it's actually a requirement, given the way that we have monetized and pay authors, and we pay people on their profit, and we don't go after them on their losses effectively, that if you're going to pay authors that way in that siloed environment, then the individual algo must basically contain its own risk management. It has to have tightly controlled risk exposures. So you might say, if I found your strategy and you happen to be the owner of the Vermont Trout, well, but hey, like it's still good. It's still doing kind of well. Let's just hedge out the risk exposure now. That can work, and we have asked people to try to do that, and obviously it's like a commonly accepted practice. The thing I think people often forget, and we ourselves have sort of come to learn and appreciate, is that of course hedging is insurance, and insurance is not free. So to think that you're going to correct and fix a strategy by hedging, you have to have the budget in the alpha to do that. And if you can't afford the hedging, and what's left over at the end is not still positive expected value, then you didn't have any sort of residual alpha that we could actually exploit. That means, if that's not sort of already like beating a dead horse here, so we're looking for algos that have low common risk, low factor exposures to these risk factors like market risk or sector risk by design, so baked in. They're thinking about generating returns from stock selection and actually thinking upfront at the alpha generation process about being cognizant of how correlated they may expect to be to the market and sort of handling that upfront. All right, who's next? Michigan Hippopotamus. So how does he look out of sample? He looks good, right? He's up, and he's perhaps got a little bit of a spike in his returns. It almost looks, again, too good. I'm sure if you are in the business ever of evaluating return stream stocks or portfolio investment strategies or funds or algorithms, something that looks like wildly good for a while can be just as, if not more, terrifying than something that loses money, because you want to understand why. Maybe it is something good. So this looks plausible, right? Which is sort of the best thing I can say about it at that point. So let's drill a little bit deeper. It's got a number of problems once we look at the sort of next tier of this analysis. So like with the last strategy, it does transiently get pretty high beta exposures. So we would have to decide what we wanted to do about that. Probably too high for us just as it's baked. The other thing, though, and So yesterday I was showing this to investors, and it was sort of like too complicated, I think, to try to explain what I really think is going on here. So I gave like a rough idea. Here's what I really think is going on here. So you know our contest, and some of you are familiar. We have this contest, and it has a set of rules. So people are always trying to submit something. Well, not always. A set of people try to submit things that adhere to the rules, but then make money through some way that's like totally different and not in line with the concepts of sort of a well-diversified market-neutral portfolio. So that's kind of what I think this strategy is. It has a exposure that's matched on the long and the short side to a set of stocks, but then it has this one additional position. So the top, you can see this like black kind of like jittering line, and then the blue jittering line, that's like one single long position that is always long, that is either exposed at about 0.5 or about 0.1. So there's one time series that's been modeled, right? And most of this data is in sample. And that's really, I think, what's driving this strategy. And I'm guessing that I think the long and short portfolio is just window dressing to get this to pass our contest rules. Now, I could be wrong, and the more charitable explanation for this would be that this is like a well-intentioned blend of two approaches that the author thinks like both are valid and both generate returns. So in either case, without a view on which of those is happening, or I guess I said I do have a view, but I could take a step back and try to not have that view. The way I think about it is algorithms that blend or combine multiple different styles, they might be great in the long run, but they're very difficult for us to evaluate without any context, right? I'm going to need to reach out and talk to this person and say, explain to me. All the time we reach out and say, what's the rationale of this strategy and want it to make sense? But here, I'm going to need to say, okay, explain to me what the two components are. It looks like there are two components. Are there two components? How do they work together? And I'm probably going to ask for a revision that separates those two components out so I can evaluate, are they both additive? And that's probably where we would go with this strategy. Okay, so this is the last example I'm going to show, and this is the best strategy as far as I'm concerned. So the first three examples that I showed you, I graded them, and then we did not put the author into our diligence process because either didn't think that issues were fixable, or just right now, there's only so many folks we can work with each month, so we sort of try to prioritize and pick the things we think are closest to being able to get over the line and give an allocation. So Georgia Pigeon, what's so great here? Very consistent into out of sample performance, plausible Sharpe. Although if you want to take the Sharpe of 2 discount off everything, you're in a dark place, but we'll get there. So this looks pretty promising, pretty consistent. Our returns in the out of sample period are within the cone that we expect. So we drill one level deeper. Lo and behold, it is possible. I talk with so many people who are like, it's really hard to control beta exposure. And I know, and it's easy for me to say when I'm not writing the algorithms, like I know it's hard to control it, but it is possible. And lots of folks are getting the hang of it. So you can see in the upper left, this strategy's rolling portfolio beta to the SPY is very, very well controlled. The Sharpe on a rolling 6-month basis is good. It's not having the greatest last year, but again, it passes that test I have of, is this recent performance the worst you've ever seen, worse than anything you saw in backtest? Not in that case for this strategy. The drawdowns, the numbers are pretty small here, but the drawdowns are pretty manageable, sort of at most 5% back in 2014. And if you look at the sort of calendarized year and monthly returns plots on the lower right, pretty consistently positive returns. So I would say so far, sort of back between the prior slide and this slide, this is basically what a strategy that we would give an allocation looks like. This looks good. So where does this fall apart for us? This looks good too, so I forgot I have these plots. But so its exposure on a dollar basis is neutral. It means it's 50% of its book is invested on the long side, 50% on the short. That's that red and green plot at the top. The second plot down, again, is the max and median position concentration. Those are probably a little high for like an institutional quality quant strategy, so it's investing up to 10% in a single name. That's not necessarily so great, but it's not a big problem. We would pass this. And the bottom plot is the turnover, so it turns over about 20% a day on average. That's okay too. We look for things that have a decent amount of turnover because we can accumulate statistical certainty using that 6 months of out of sample, we feel. But too much turnover, and now suddenly when you're really modeling costs appropriately, it's going to be a heavy lift to overcome those. So this still looks pretty good. So then where does it run into problems? Well, much more subtle problem that we have been working to sort of correct further upstream. So if I look and do a P&L attribution and say what % of the strategy's return are driven by stocks that come from the Quantopian 1500 universe. So we built a liquid tradable universe that we think is sort of representative of what we can trade in our investment vehicle. And then what we've been doing is now, since we've built that, but strategies have been written long before we built that, we go back and say, hey, P&L attribution, what % of your return came from a set of stocks we think we can trade today? So, okay, half, you might say, well, that's not that bad. Like, half is better than nothing, right? So, and we thought that too. So we said, okay, great. Georgia Pigeon, please update your universe definition and pull in the Quantopian 1500, and let's look at how that looks. So unfortunately, though half of the return seemed to be driven there, that's a lot of headwind for the strategy to overcome. And once you run it on the universe of the 1,500 most liquid names in the market, now you're falling below a Sharpe of Outofsample, below 0.6. So I think what this highlights to me is this is not an issue that's unique to this one algorithm by any extent. I think it's very common in quant, and in my former life when I worked on building like equity stock selection models for StarMine, it's something that we would see all the time. Unless we corrected for this ourselves, we would see that a lot of the signals we would figure out in the market when we just rank everything at the tails is all this garbage, right? Like weird outlier data, illiquid microcap stocks, things that aren't really stocks and you mistakenly thought were stocks. It's dark out there at the very tails of the distribution, right? And so unless you form your universe properly and get rid of all that crap, you're going to identify it, pick it up, amplify it, and maybe put a large % of your portfolio in it. So that's a problem, and it's not unique to this strategy by any stretch. So like I said, in this past summer, we wrote a universe definition that we could share and open source in our community. It's a single line import. From Quantopian pipeline filters, import Q1500. I think there's a 1500, a 500, and I forget if there's a built-in 3000, but this function is also parameterized such that you can call our same screening on any size universe that you want. So if in your own pursuits you're not as interested in allocation, or in either case, whether you are or you aren't, but you want to look at a larger universe, like 3,000 names, you can pass a 3,000 requirement to a function and you'll get the same thing. All right, so a little bit of a trail of tears, walking through all these strategies that don't get an allocation. But what have we learned by doing this? I personally feel like I certainly have learned a ton. Maybe not through just walking through them now, but through this selection process, it's obvious to me that algorithms that don't make the grade can still be extremely valuable. I think that's true as feedback to authors when they see that, and it's also really true for us. From the Quantopian perspective, it's true because every time we discover a failure mode, be it obvious in hindsight, like most failure modes are, we can take that information and we can feed that back into our product development team and our educational and content development team, the entirety of which is seated in the last row of this room right now. So I'll go back and I'll say, Delaney and Max, for the love of God, you got to tell people to stop screwing up all of these common things. And to their benefit, they do that, right? So there are lectures that these guys have written that address every single one of these issues for these 4 strategies that I talked about. So beta hedging, position concentration risk, overfitting, and universe selection are all available as notebooks to sort of try to help teach users, authors, how to correct for these problems. Ideally correct for them right at the beginning when they think about developing a strategy. So the last thing I'll point out, though I don't think anyone here doesn't know this, but all of the analysis that I talked about is from an open source library that my research team has built called Pifolio. We've also built an open source library called AlphaLens, which is one step up in the development process. So Pifolio takes a series of returns and potentially positions. If you decided how you want to trade your strategy, you can use the same analysis that I use to evaluate it yourself. But if you're one step up from that and instead you have a stock ranking factor or predictive alpha factor, and you just want to say, hey, without deciding what names I want to buy and sell, what does that look like? That's what AlphaLens does. And obviously Zipline is the older library that has been open source for a number of years. That's the basic backbone of our backtesting infrastructure that you use on the platform. So those are all available for you to take a look at. Try to find problems or things you'd like to improve about them and get involved in those projects. We're extremely enthusiastic about having community members work with us on the open source projects. So with that, I would love to take some questions if there are any. I don't know if I have a mic to hand out in the audience. Yeah?
Have you disclosed how many algorithms you've allocated?
I think so. I will tell you now. I think we have disclosed it. So we have 17 strategies that are trading right now from 15 authors. So we allocated our first algorithm in prop trading on Interactive Brokers in September of 2015. And then we basically organically grew that over the course of that year and a half. And then we brought that prop account down in December because we were moving to an institutional prime infrastructure. So we just launched our first account April 1st and just closed our first month of trading, which I know I'm not allowed to talk about, so don't ask me about that. But yeah, 17 strategies, and then we're now going to probably be, I think, hopefully back on the growth pattern that we had seen in prop trading, where we're trying to add 1 to 5 and eventually maybe more strategies every single month to that.
Any kind of performance that you can reveal on that?
I don't think I am allowed to talk about it, so. We're going to keep trading next month. You can extrapolate from that, I guess. Yeah.
All of these strategies will have some kind of strategy to update the set of working algorithms on a
Yeah.
monthly.
Yep. Yes. Yeah. So what we do is, I'll tell you the way we developed it. If you go to Jonathan's talk after this, you'll see all the math, which I will skip over all of that. And basically what we did at first was just try to make these binary decisions like, yes, this has positive expected value. So we did that up until we got to about 6 algorithms, and then we said, okay, this feels like it's turning into a portfolio. We think we're ready to apply some portfolio construction. So at that point, we just basically did an inverse variance weighting, so risk equal risk budgeting. That was extremely helpful in targeting a more reasonable vol on the overall portfolio of strategies. And now we have a balance between sophistication, complexity, and robustness, right? But now we have a little bit more sophisticated portfolio construction process that we run today. It's monthly, reweights the algorithms, and it considers their variance, so their risk budget, their capacity, and their beta to the market. So eventually we'll probably consider more risk factors. And then it doesn't yet consider, but it is extensible to include sort of what we call skill awareness. So right now we think of it like, again, yes or no. Do you have positive expected value? But you can imagine once we accumulate real out of sample on our live trading infrastructure, we'll probably get more, ideally, we'll get more confidence on strategies that have been running for longer. So we have a framework where we can sort of bake in updating, instead of having a prior that everyone has the same Sharpe, start to update and say like, hey, we think this strategy has a higher Sharpe than this strategy, and then you could sort of do an optimization. And that's how we do that on a monthly basis. We want to try to keep it pretty smooth because you don't want to incur a bunch of extra trading costs just turning the portfolio over to rebalance a little bit here and there. There's another question up front.
How many algos do you analyze on a monthly basis and with how many people?
Yeah. So we do 2 components. Like I said, there's this sort of like low touch and then high touch. So we screen through. It's changing over time. I mean, I guess like thousands, order of thousands to tens of thousands, I guess, a month, sort of screening mechanism. And then I have like 3 or 4 analysts that work with me, but mostly it's 2 of us usually grading the strategy. So we're probably grading by hand, a couple hundred a month, something like that. And we have tried to dedupe things up in the process. Every time we figure out something that can be automated, we do. So that's kind of the ballpark. We are working on a big project right now to try to broaden the net even a bit wider because we've learned stuff. And so we probably will go back and increase the stuff we're looking at even that's older, and then we continue to see kind of growth. So I think our big problem is just going to be keeping up with, the way we described it with one of our product managers, Dan. His project is like making the haystack bigger, right? And I'm still looking for needles in it, and it's difficult to know if there are necessarily more needles when he makes the haystack bigger. And so that's sort of the balance and problem that we're trying to work through.
And do you do it for standardizing the selection process, or through those screens that you showed? Is that you apply always those screens, or you?
I look at the same analysis. Not yet. Everybody was done. Yeah, I'm sorry. So I look at all those screens, and I described me as a human is looking at them and having these observations and then making decisions. And so Like, wouldn't it be cool? And isn't it? I'm paraphrasing here, but it would be cool, and we want to apply machine learning. So we've got like a several thousand graded data set of these algorithms, and so we've done a little bit of preliminary work on like learning and replacing me with a robot, which I'm sure is fine with me. That's awesome. I'd be happy, and then I will talk to the robot from my yacht. So we're working on that, but I think, like it's going to be implementation details of exactly how to get that working. The piece that I don't, well, maybe you can do this part too. The part that I feel like I would still add value is like you have to judge the economic rationale. But then I was saying that to someone and they're like, oh no, not at all. You just like do NLP and then you can like learn and see if they match up and you really don't need a person at all. So that would be the end game. Foss, our CEO, would like absolutely love it if there was no, human discretion anyway through the process and everything was automated, which is terrifying, but yeah.
Do the algorithms have to be 6 months old so that you're sure that they didn't use your out-of-sample data to train?
Well, so we are hoping they don't have access to that out-of-sample data because they wrote it 6 months ago. So they're training on some unknown amount of data prior to that 6 months, and we assume on a conservative standpoint they used all of it and overfit to it. And then we're using that most recent 6 months as out-of-sample. Like why 6?
So you know for sure that they didn't train on the most recent 6 months data?
Well, what we want to do is say, assuming you trained on all the prior data, does that model that you built by training on prior data generalize to this new data that you couldn't possibly have trained on?
Well, that's what I'm getting at. They couldn't possibly have trained on. You could accelerate your program by 6 months if you trusted them that they didn't train on it.
Yeah. I don't, though. Yep.
So just in terms of the decision tree, when you're looking at algorithms,
Yeah.
if in the 6 months that are out of sample, the algorithm isn't living up to what it has been doing so far, or not expectations, how do you know that's not just, or I mean, do you know, or how do you decide whether that's just kind of unlucky, the
Yeah.
algorithm's cyclically going through its drawdown?
Well, yeah, exactly. That part becomes a little bit subjective. So what I do, and like I developed this organic grading scheme, which now has been translated back into like a 1 to 5 scale. So what I would do if I think that's the case, plausibly, is not give the algorithm like a Z. So here's my grading scheme. I'll tell you it because I think it's also going away. I was like, oh, things should be like an A or a B, or maybe a C, right? Like 3 things. And then I was like, oh no, there needs to be a Z. Z is like, I told the guy who works in the data stuff, Z means never let anyone see this again. Like that was like 3 minutes of my life I want back. And so then I was like starting to grade things like B+ and A-, and they're like, oh no, this is horrible. You're getting out of control here. But what I was trying to do was say that, right? Like, so this isn't working, doesn't look like, but maybe it would come back. Maybe it's just a market regime. And if it's not trading that frequently, maybe you want more time anyway. So then I would grade that, and it goes back into the database, and it gets run every month. And every month it like revisits and haunts me, and I see like, oh, is it looking better now? Now I do think that that's like, well, Delaney and I have talked a lot about this. Like, if you just eventually keep watching it every month, like, you don't want to just like then have it have like one big good up month, and you're like, oh, well, now I have confidence in it, and so I allocate to it. So I think you do have to be careful about that. But yeah, I think it's like a gray area because you are comparing these really 2 different time scales of data set. What would be perfect is if you have, if you waited, right, like you have like a 5-year back test, you wait 5 years into the future, then you have equally sized, right? That's perfect. And I remember I was on a panel in Boston the other week with someone who said, if you have, I forget the exact like equation, but he was saying if you have like an information ratio of 1, or you want to prove that's true, it takes 16 years of observing someone's track record to like be sure about it. And everyone was like, that's not actionable, but it's a very interesting data point. So we have to make the decisions, and that's kind of a lot of why we picked 6 months, was just as that heuristic. So I think I'm about out of time. Do I have time for one more question, if there is one? Maybe there isn't one. Okay, yeah.
Yeah, you talked about replacing yourself with Overlord, which, I mean, I think it's nice that...
Not Overlord. I'm still in charge of the robot. They do the work, and I'm the Overlord, I thought. Either way, I guess. Yeah.
Yeah, sorry. So my question to you is really, that you're showing us these graphs and so on. Are you actually visually inspecting those, or are you getting the
I am visually inspecting them, which I know is like deeply troubling to all the machine learning people and decision tree. They're like, so exactly the features you extract, how do you then see them? And I'm like, no, I look at it. But we are doing that too. So I have this brilliant data scientist on my team whose name is Thomas Wicke. He gave a talk that I think was packed earlier. So I'm looking at them, and I think I'm adding value. We have we literally are working on this project right now that I think will prove that my selection adds no value, and if possibly negative value. But anyway, I look at them, just like what I told you and showed you now. I literally then also check, like, who is this person? And I Google them, and I'm like, oh, look at them on LinkedIn. Oh, they seem plausible. And I try not to let that bias me, but I'm just curious to see, like, does that corroborate? So I won't be allowed to do that, I'm sure, in the future. But we also extract, like, 50-plus features from and so those would be things like, the mean, median, high, low, et cetera, of all those different time series that I look at. So we have a set of about 50 features that we've used for this sort of prototype of the. Basically, what we did was say, oh, can we predict the grade that Jess will grade it?
Right. You're the annotations.
And I forget what really the results, how good they were so far, but we're still working on it. Like, we still need a bit more data, I think, basically. But like, I don't see why it wouldn't work. It seems very rules-based to me as I'm doing it. The thing that I think will work well, I'm not a machine learning expert, like, by any stretch. I just am like, learn enough from the people around me to think, can we use it? And the thing that I think makes it tricky to just purely do this with, like, a priori filtering is that there's styles. So it's like there's not a pure rule, like you have to have more than n positions, because if it's a basket or it's these pairs and we're still willing to take those, you have a small number of positions. If they're well hedged, maybe that's okay. And then in another context, if they're not, and you have a small number of positions that never turn over, that's not okay. So there's all these different, like, sort of, styles of algorithms, and I would assume that the right, robot would be able to learn, like, and classify them, and say, oh, well, it's a classification problem then. And then it'd be, yeah, exactly. So I think that would be really interesting. All right, well, I will be around afterwards. Be happy to answer any more questions any of you have. Thank you so much for your patience and attention.